Black Monday refers to a crash that occurred on June 12, 2015, in the Shanghai Stock Exchange in China. This crash occurred after a period of rapid economic growth in China and had long-lasting effects on the global economy. China's economy had been experiencing rapid growth since the early 2000s, leading to its emergence as one of the world's largest economies. However, this growth was accompanied by several underlying problems. What was Black Monday, and what was its impact on China's economic future? How has China's economic growth evolved in recent years, and what are the future growth trends? For all this and more, before starting the video, if you're interested in universal economic history, you can subscribe to my channel and turn on notifications to be informed about new videos I upload every day. Enjoy the watch.
Universal economic history.
China's growth model relied heavily on high levels of borrowing and state intervention. While this model provided short-term economic gains, it was not sustainable in the long run. The crash in the Shanghai Stock Exchange was a result of these underlying issues. The crash on Black Monday caused panic among investors in China, leading to massive sell-offs. These sell-offs resulted in a sharp decline in stock market indices. Furthermore, this crash caused fluctuations in stock markets worldwide, with Asian markets being particularly affected. The Chinese government took a series of measures to intervene in this crash. For example, a fund was created to purchase stocks of companies, and the People's Bank of China supported the market by loosening monetary policies. However, these measures did not fully resolve the crisis. Following Black Monday, serious questions were raised about China's economy and financial system. This crash called into question the sustainability of China's economic growth model. Additionally, there was a decline in China's international trade and investments. Risks of China's rapid growth. China has become one of the world's fastest-growing economies in recent years. This rapid growth has led to significant changes in China's economic and social structures. However, China's rapid growth has also brought about certain risks. China's economic data, particularly growth rates, are viewed with skepticism by some experts. As a result, it becomes challenging to obtain a clear picture of China's actual economic situation. Additionally, the uncertainty in China's economy can undermine the confidence of international investors and lead to reduced investments. China's rapid growth has led to the rapid consumption of natural resources. This is particularly true for energy resources such as oil and natural gas. The depletion of these resources can hinder China's economic growth and have implications for the global economy. These financial risks include issues such as property market bubbles, the banking system, shadow banking, and debt. China has experienced a significant population increase and rapid economic growth in recent years. This has resulted in a rapid increase in the property market due to the demand and supply balance. People started buying properties for investment and speculation purposes, leading to a rapid increase in property prices and the emergence of a property bubble. The banking system is another source of financial risks in the Chinese economy. Banks in China have high levels of non-performing loans, and the lack of regulation in the banking sector increases financial risks. Non-performing loans in the banking sector can weaken the bank's balance sheets and, consequently, pose a risk of an economic crisis. Shadow banking, which is an alternative financial system to the formal banking system, is another factor that increases financial risks in the Chinese economy. The shadow banking system often involves high-risk loans, speculative investments, and manipulations. The shadow banking system reduces the transparency of the financial system and increases financial risks. Exchange rate policies have a significant impact on a country's economic performance. These policies are used to regulate and maintain currency exchange rates in international trade. Exchange rate policies directly affect a country's imports and exports, price stability, inflation levels, and unemployment rates. Firstly, exchange rate policies are used when a country aims to increase its exports. By keeping the exchange rate low, the country's currency has a lower value, which reduces export prices and helps increase exports. Exchange rate policies can also be used to reduce imports. By raising the exchange rate, the cost of imports increases, leading to a decrease in imports. Secondly, exchange rate policies are used to maintain price stability. If a country experiences high inflation, exchange rate policies can be used to lower inflation by depreciating the currency. Similarly, if a country is not affected by inflation, raising the exchange rate can help maintain price stability. Thirdly, exchange rate policies have an impact on unemployment rates. By keeping the exchange rate low, it is possible to increase exports and employment. Additionally, exchange rate policies can be used in conjunction with monetary policies to reduce unemployment. The China economic crisis had significant effects on the global economy. One of the most notable impacts was an increase in unemployment rates. China, being one of the world's largest producers in the global economy, had its effects felt worldwide. The rise in unemployment in the manufacturing sector in China led to disruptions in global supply chains, affecting production sectors in other countries. The world economy heavily relies on China's exports and consumption. With the impact of the crisis, global consumption and demand decreased. As a result, global economic growth rates slowed down, and some countries even experienced economic contraction. This situation particularly led to an increase in unemployment rates in developing countries. Moreover, the impact of the crisis was felt in financial markets as well. The crisis affected stock markets worldwide, causing significant losses for many investors. The impact of the crisis further exacerbated the instability in global financial markets. China is one of the largest consumers of commodities worldwide, and therefore, fluctuations in global commodity markets have a significant impact on its economy. During the 2015 China economic crisis, global commodity prices experienced a significant decline. China, especially known for its demand for commodities like iron ore, copper, and oil, experienced a decrease in demand due to economic slowdown and industrial contraction. This led to a decrease in global commodity prices. In particular, iron ore prices almost halved in 2015. This had a significant impact on mining companies and producers worldwide. China consumes about half of the world's iron ore production, so the decline in demand resulted in significant pressure on mining companies and producers. Copper prices also experienced a similar decline. China accounts for about 40% of the world's copper demand, and in 2015, copper prices dropped by around 25% due to reduced demand. Oil prices were also affected by the China economic crisis. China is the second largest source of global oil demand, and oil prices significantly dropped due to reduced demand. China has been an attractive market for foreign investors for many years. However, the economic crisis in 2015 created certain risks and opportunities for foreign investors. Firstly, during the crisis period, profitability of companies in China decreased, and certain sectors faced significant challenges. This negatively affected the returns on foreign investments in China. Additionally, with the increasing number of foreign investors in China, local competition intensified, leading to price decreases. However, the China economic crisis also presented various opportunities for foreign investors. Particularly during the crisis, the Chinese government announced a series of regulations and incentive packages to attract foreign investors. These incentives included participation in the privatization of Chinese businesses, internationalization of domestic companies, and investments in China's high-tech sectors. The 2015 China economic crisis provided important lessons and takeaways for other countries. Here are some key lessons that can be drawn from this crisis. China's economy has become a significant player in the global economy, and the crisis demonstrated the impact of China's economy on the global economy. Changes in China's economy, alongside global economic conditions, can affect other countries. Crises can have significant effects on economic regulations and policies. During crises, governments can introduce regulations and incentives to stabilize markets and boost economic activity. However, if these policies are not sustainable in the long run, the effects of the crisis can intensify. In conclusion, the China economic crisis in 2015 offered valuable lessons and takeaways for other countries. Taking these lessons into account can contribute to ensuring global economic stability. Thank you for watching my video. If you liked it, please hit the like button. If there's a specific video you'd like me to make on economic history, don't forget to mention it in the comments section. I wish everyone a pleasant day.
Universal economic history.